Good afternoon, ladies and gentlemen, and a warm welcome to our digital roundtable with INDUS Holding. My name is Konstantin Völk, and I am the analyst on the stock together with my colleague Christian Santer. We rate the stock currently as a buy with price target of €36. After a short presentation, we will start with the Q&A session. And to ask questions, you can either raise your hand or write the question in the Q&A text box. With me today is Dafne Sanac, Head of Investor Relations at INDUS. Ms. Sanac, the stage is yours.
Thank you very much, Konstantin, and thank you very much, Christian, for the opportunity to present in this new format, which we highly appreciate, which is a bit more dynamic than the usual formats we've seen before. So I'm going to present INDUS, walking through basically the business model, the numbers, and the latest strategic developments, and open the room for questions. So just once again, also welcome from my side. My name is Dafne Sanac, Head of Investor Relations at INDUS, over 4 years now, and presenting you now the company and the business model. So overall, I think most of you, if you have read the note of NuWays, know that we are a holding company, but it's very important to point out the core of INDUS. And we basically are the specialist, or we are known for succession, like business succession. So for family-run businesses that basically have a niche in an industrial technology value chain, and they're looking for a successor. So INDUS is the first point of contact. So basically what we do is we keep the legacy of the company, and we have the mantra, so to speak, buy, hold, develop, and not selling the company. So we're creating value by developing the company, and I will basically explain a bit more about the pillars and the strategic values behind that. In addition, obviously, we internationalize our subsidiaries or the holding companies, and we help them as much as we can to the next innovation stage. So this is like the INDUS core. So sustainability is playing a big role within the INDUS business model. So we've got 4 pillars, which I will talk about later on as well. And one is striving for sustainability. But if you see the whole universe where INDUS is active in, basically portfolio companies, obviously the sustainability comes into play because we keep up the life work of the managing director, or of how we say in German, Geschäftsführer, and evolve it within a secure framework. The shareholders, on the stock exchange, have the opportunity to actually access a portfolio of SME companies they might not otherwise be able to access via the stock market. So combined within INDUS, they have all like a representative frame of the industry within one stock. Obviously, we adhere to all the standards like the Lieferketten-Sorgfaltspflichtengesetz and all the other CSRD and all the commitments that you have to do via regulation. So all stakeholders profit from INDUS, a member of society committed to sustainability. And the last point in the bottom right corner, entrepreneurs intending to sell. Basically, that's what I said before, that we are the number one for the succession of family-owned businesses. So how does the capital market value our striving for sustainability? We look at ratings quite a lot intensively. We look at S&P and ISS and basically fill the data in quite detailed, so to speak, but we have a top position in the ISS ESG rating, and we rated with a C+ prime for the 9th time. So why are we doing this? We're doing this particularly because of favorable finance conditions, also for our promissory note, which we give out every year, and therefore with our C+ rating, we basically get an advantageous condition. So overall, this is the INDUS DNA I talked about. So INDUS, specialist or holding company for succession, buy, hold, develop, and basically with a huge focus on sustainability, either being long-term, consisting of basically keeping up the values of the Mittelstand companies, or actually looking at what the capital markets requirements are. So basically, next is Parkour update. Parkour is the strategy. So basically, this is covering the entire value chain of INDUS. So you've got 4 pillars, and each of the pillars is headed by one of the board members. So one is strengthening the portfolio structure. 2, driving innovation, improving performance is the 3rd one. Striving for sustainability is the 4th one. So the first one basically is headed by all of the management board members. The second one is headed by Dr. Großmann. The 3rd one by Axel Meyer, and the 4th one again headed by Dr. Großmann. So what does it mean, basically strengthening the portfolio structure? I mean, that is the value chain of INDUS, acquiring small and medium-sized businesses with a revenue of 20 to 100 million euro with a good EBIT margin of above 10%, which with no debt at its best cash generation. And this year we set aside 70 million, which is a bit more than last year because we've got such a strong free cash flow of around 200 million in 2023. And the M&A pipeline is currently very well filled. I mean, with growth acquisitions and add-on acquisitions. And I will talk about the distinction on the next slide. And attractive targets in the future fields are infrastructure, network automation, energy technology. So within the segments, I mean, most of the targets would be in engineering. So I hinted at the words growth acquisition, add-on acquisition. Growth acquisition meaning on the first level, meaning that the holding company, so us INDUS, is buying in addition to the portfolio, but also we give the portfolio companies the opportunity to buy an add-on acquisition to expand their portfolio or their value chain. For instance, Hauf, Gridcom, or what we did before in the previous years. So this is for instance an add-on acquisition. So this is I will just quickly go through it because there's a lot of text on this slide, but maybe we can send this around later. So overall, TK Limit and Horn Group, so they are basically specialists for fueling systems, and what we're trying to show is basically the revenue growth that you generate, and also the revenue growth you generate with the add-on of TK Limit to the Horn Group. So basically what you do is you have an existing value chain, for instance, now with the Horn Group manufacturing of fluid transfer system, automated inventory management systems. So basically in the end, you add TK Limit, for instance, to grow your market and also expand internationally. The same here with Course and Excel and PCL as part of the Horn Group. It's basically, I'm reading it out and you can see the picture as well. It stays complicated, but still, please have a look. They're a manufacturer of industrial valves for measurement and control technology. Maybe that's all you get to remember. And basically the thing is, what you have to look at is that you're expanding the portfolio in the sense of the vertical value chain and geographically. So this is another very interesting acquisition, but this is the segment infrastructure. So Hauf is doing entry systems, like basically entry system for like residential buildings, or like how we say in German, Hauseinführung. So things or materials that cover cables that actually go from, for instance, into the building and outside of the building, and Gridcom products covering the last mile in these networks. For instance, you can see these POP stations, slice patch modules, and distribution units. So we actually expanded this. It's all, obviously driven by a mega trend. I mean, we all know about the fibers that have to be laid out in Germany. So Hauf acquired Gridcom and added the last shares in 2024. So overall, sorry, this is just skipped. Overall, this is like our strengthening the portfolio structure. I pointed this out because these have been the developments we also did in Q. Like some of them have been done in Q1. So basically, you can see that we are being quite dynamic in the last month. So driving innovation is like the second pillar I talked about, and this is like just extract, basically revolving all around the trend of AI. And I mean, we did this acquisition, Gestalt Automation or Gestalt Robotics, how it is also called. And this is revolving around the automation process, basically in the data science field. And what you can see on this slide is our collaboration with famous universities and institutes like the Fraunhofer or the TU Munich, who are very leading in these areas of development. In addition, what's not to neglect, we have the INDUS Innovation Development Bank, which is basically like an institutionalized unit giving out funds for very innovative projects within the portfolio companies, meaning that one of the employees or the person in business development has to make a suggestion which will be evaluated on holding level, and then we actually give the funds to finance a very innovative project in the line of automation, or also now we have something called AI Sprint, as we pointed out before, which is driving forward innovation for the entire holding. Yeah. So this is like a bit of the sense of the numbers you can see in here. So the continuous increase by granted projects, and what you have to keep in mind that we budget like 3% of our group EBIT for innovation. So this is like one of the innovation projects that we work on. Yeah, actually, I talked about this, Gestalt Robotics. I don't know if most of you have read the news release. So Gestalt Robotics is basically, you can see AI-supported image processing. They can observe basically certain value chains and point out maybe mistakes within the automation, mistakes within the production process, and generally are focused on intelligent robotics. But they're going to be focusing on their own business, while they might be minorly also focusing on serving the existing portfolio companies and helping them to dive into AI-related production. Yes. So third pillar, improving performance, which I pointed out before, is basically separated into operational excellence, which you can see on the top, and market excellence, which you can see on the bottom. And like on the top right corner, you have improving performance. So I'm just going to make this a bit easier. So basic market excellence, what is included in market excellence? It's everything about market entry support for the holding companies, meaning if you want to branch out to a market, you can either go via the local structure to build up a sales and service point, or shift the entire production in a new geography. So basically we have like a so-called, well, this is my word, I'm using like an in-house consulting team of most of them like engineers that have a PhD, and they basically go to each of the portfolio companies where they see potential and have like a market excellence agenda and an operational excellence agenda to improve the performance. I mean, for all of you, I mean, finance savvy people, I mean, operational excellence mainly is used to improve your EBIT line, right? To basically lower material costs or lower personal costs, increase automation. This is basically what you include in operational excellence. Driving sustainability, fourth pillar, energy efficiency, and obviously sustainability as a whole is very important to Indus, but it's very important that it's measurable. So to conclude this, I mean, in 2023, 5 projects, basically I have to go a step back. So basically, we have a sustainability development bank, which is close to the concept of the innovation development bank, meaning that also the portfolio companies can contact us for sustainability projects, even meaning installing solar panels or something similar. So overall, this should encourage the reduction of our emission intensity. And I'm just summing this up for the most important numbers. So we basically achieved a 36% decrease of emissions in 2023. Internationalization is a big topic that's basically above all the pillars, but plays a role for some of the segments, or basically, well, if I look at the slide for infrastructure and engineering, I'm just going to point out some of them. So basically, Aurora, for instance, is a company that does air conditioning or heating systems for commercial vehicles. And they expanded manufacturing facilities for US customers. H&S is a company that is producing machines for food packaging. So basically, meaning if you have the salad box with a transparent cover, which you get like at Pret-a-Manger or at other food chains, or the Raffaello box, and they are doing the customized machines to basically produce these boxes. And within the sustainability trend, obviously cartonage and similar options are very interesting, obviously. I mean, another point, maybe M. Brown, they're doing glove boxes for inert gas systems. I'd highly recommend to look at the website, and they're mostly used like at universities, for instance. And maybe like to make it a bit more tangible, Vulcan, they're doing granules for surface treatment, meaning if you have an iPad which has a very smooth back, you need granules for surface treatment. So that's what Vulcan is doing. So this is a good overview of our recent internationalization activities. And what you have to keep in mind is that INDUS is basically generating more than 50% of revenue outside of Germany already. So this is what I already said. I mean, how does INDUS support internationalization? It's by setting up locations, strengthening the network, supporting through training courses, and also looking at the other support functions like legal support or accounting. So for the ones that do not know INDUS maybe that well, I'm just going to put on a slide with like the full year figures so you can grasp what kind of values we're talking about. So we're doing like 1.8 billion of sales, like an 8.3% margin, and generated a free cash flow of nearly 200 million. Our leverage is 2 years, and we had a dividend yield of 5.4%. Yes, basically, I'll also talk about a share buyback program later on. But as the title of the presentation says, deep dive into Q1, and we're getting there now. So basically, obviously in Q1, which was January to March, which still, I mean, conditions have been not easy within the industrial landscape, and we expected Q1 to be a weak quarter. So basically, the strongest quarter is usually Q4, then Q3, then Q2, and then Q1. So basically, it was already already counted into our guidance. So this is why we say first quarter performance in line with expectations. And obviously this can be seen within our sales number, 9% due to operation weakness in all segments. Despite infrastructure, we think that the trough has actually gone by and that we can be content with the development. And I will talk about this later on. Obviously, the drop-through rate has been suffering, so the EBIT margin was only 6.5% instead of 9.9% the year before. And I have to point out something about the free cash flow, because last year we had a positive one-off effect of around 15 million And if you eliminate that effect, our free cash flow of around 6 million, I think, would have been really good. I mean, would have been a good number compared to previous year. Our equity ratio is stable compared to previous year, and we already did 3 acquisitions in the first quarter, which doesn't influence the guidance we've already given, because we still want to do two acquisitions, and there's still around 50 million left to spend of the 70. We did a successful, we had a share buyback program, which was very successful. Basically bought back 1.1 million of shares at a unit price of 23 euros. And now basically, and we're confirming the guidance for 2024, which I will talk about later on. So going a bit deeper to the numbers, I mean, sales has decreased by 9%. EBIT, I've already talked about this. And we've also introduced a new number called adjusted EBITDA. What does it mean? Basically, we adjust the EBITDA by the PPA depreciation. And PPA depreciation obviously comes up if you acquire companies. You basically you allocate a certain value to the assets, and then you have the basic PPA depreciation that reduces your EBIT. So what we are showing is basically the adjusted EBITDA to make it clear to the capital markets what our activity of M&A, what kind of effect it has on our EBIT line. Yes. So just to look at the free cash flow, I mean, that's what I talked about before. I mean, cash flow from investing activities, we already spent around 12 million, but there's not everything in there because the closing dates might have been outside of the first quarter, but still, I mean, around the 50 million to spend on M&A. So engineering, now it's becoming a bit more detailed. So we have 16 companies in the segment. And I'll let you look at it for 2 minutes, maybe, 1 minute, or so you can digest what companies we put into this segment. So it's all around automation, assembly, conveyor, fluid, machine tool building, measuring and surveillance technology and process technology. And let me just point out, Jungmann, for instance, for the ones that do not know, they do surveyor technology. Basically, what they do is the control rooms for highly complicated value chains, but also for transport systems. So this is a pretty new company we acquired. Not recently, but the years before. So engineering is basically one of the reasons why our EBIT has been decreasing in the first quarter. I mean, the sales line has been declining by 8% due to the current business in the sorting systems and packaging technology systems. And also the EBITDA, adjusted EBITDA, fell by around 8 million. I mean, this is due to the fact that the order book situation has been bad in the Q4 of 2023, and coming into the Q1, this has actually transferred into the revenue line. So, but we think that basically the trend, the trend is lightening up. I mean, like today the VDMA numbers came out, and basically it says the same. I mean, that the recovery is going to be expected in the second half of the year. So in numbers, I mean, I'm not going to read it out. You just have a look. You can see that the margin has dropped significantly due to mostly the drop in sales and due to the material costs. Obviously, that are still high. So for the entire year, we're expecting a slight increase in sales and the EBIT decreasing, and the EBIT margin between 8 to 10%. So basically, if you look at the engineering segment and you just want to have a glimpse or feel which companies are actually included and how successful has INDUS been in developing the companies, I pointed out M. Brown before, which is a company that does inert glove box systems. So what you can see overall is how we developed the sales line from like a 38 in 2002 to a 100 million in 2023, and we're still going to expand the company internationally. Infrastructure, so 14 companies are within that segment, and I mean, if you want maybe another segmentation within the segment, you can see that around 2/3 are maybe construction, and around 1/3 might be related to residential construction. Infrastructure obviously serves the mega trends of mobility, urbanization, digitalization, and sustainability. And we see the future acquisitions in infrastructure, networks, buildings, and obviously energy efficiency. Bureaus has been a latest acquisition, a latest addition, and they're basically doing window frames, right? Like for residential and commercial buildings, yeah. So infrastructure, I mean, the EBIT margin has improved by 1 percentage point, and I already hinted at that we can be quite content with the EBIT or with the infrastructure development. So despite the muted sentiment in the industry, we can be quite content with the increase in the EBIT margin, which is also due to a restructuring within one of the holding companies. So overall, what we are seeing for 2024 is a slight increase in sales, and the EBIT strongly increasing, and an EBIT margin of 10 to 12%. So here another positive example of how we actually have developed one of the portfolio companies, Aurora Group. So we increased the international sales from 44 to 59%. Materials is a very diversified segment because we also put the former companies of the medical, which we call medical segment, into this segment. So meaning that you have companies that focus on processing materials, and the other ones are more in the medical sector, like Microb, that does small lenses for medical applications. So it's driven by megatrends, sustainability, mobility, urbanization, demographics, and health. And for acquisitions, we focus on industrial materials and processing, for instance, and circular economy, recycling, agriculture, and food industries. So the materials segment, also the business activity has been calmer, which we've also anticipated, which has also been due to the decrease in agricultural machines or applications that are used within the agricultural field. So we had like an 11% decline in sales, and the adjusted EBITDA fell to around 12 million. So overall, what's to expect? I mean, if you look at the sales and turnover and basically the industry trend compared to last year, where we're able to keep price increases quite strong for a certain while, and the material costs in check. So this year, this is going to be a bit more normalized, so to speak, that you see an EBIT decreasing and the slight decrease in sales, which leads to a lower EBIT margin. So we see as well a decreasing business activity in 2024, yeah. So, well, another example we put in to make it a bit more tangible is Simon, which is one of the biggest, the biggest portfolio company we have, with around 300 million of revenue. They're doing round shank picks, which are the picks that are used for road milling. And they're doing other products, but this is basically the product you have to keep in mind, yeah. And they're also applicable for land machines and in the agricultural field. So now we're already coming to the looking forward or to the future topics. So that, as everyone has seen in the media, I suppose that Germany lags behind the international economic recovery course, despite we can see a slight growth in Q1. I mean, there are slight indicators that show maybe a different trend, but still the business climate is muted, and the sentiment of the German economy is quite dark, I'd say. But let's see what's going to come in Q2, and Q2 is nearly. Well, we're now in June, so basically there's only some days to go. So what does it mean for Indus? We confirmed our outlook. These are the segments. I mean, I've talked about this before, so I'm not going to go into detail. But overall, for our group, this is how it's going to look like. I mean, a slight increase in sales. I mean, our EBIT pretty stable. A slight decrease in the margin, and still a solid cash flow of around above 110 million. And we're still, with the cash we have at the moment, we still can afford to growth acquisitions and further add-on acquisitions. And we're still looking at a leverage of around 2.3 years. We're going to keep the leverage at that point. So this is how it all adds up, I mean, to our forecast. But overall, we have 6 targets in mind. I mean, we want to expand our portfolio. We obviously want to increase sales organically and by acquisitions. The EBIT margin is going to be above 10%, and like a run rate of the free cash flow is going to be around 110 million. Indus has never not paid dividends, so we're continuously paying dividends. So this is like inherited in our 6 target structure. So regular dividend payments is one of the targets we keep up. And obviously, sustainable portfolio activities is making the sustainability agenda more and more measurable. I mean, this is a target for nearly every company. Yes, exactly. Now the buyback program. I mean, like you can see treasury shares, which are 4.1. So basically, it's an overview of our shareholder structure. But I take the opportunity that we've done a buyback program of the usual reasons. I mean, obviously, we're not allowed to say that we think. We're not allowed to talk about the value of the stock, but we are allowed to say, I think, that we think that the Indus stock is a good investment. So we actually invested in the Indus stock. And just to illustrate what has changed, I mean, the Versicherungskammer Bayern has now 13%, Protector has now 5.4%. And overall, that's how the shareholder structure is set. I mean, most of the shareholders come from Germany. Then afterwards, maybe Norway, and then the US. So I think this is it. I mean, we had a vivid Q1. I mean, there were 3 acquisitions we made, and we presented our figures. We had recently, we had our AGM, which is not Q1. We had a share buyback program, and I'm looking forward to some questions now.
Thank you very much, Ms. Sanac. We will now start the Q&A session. To ask a question, please raise your hand or type the question into the text box, and we already received a couple of questions. So the first question is about the automotive carve-out. Historically, you never sold a company. With the heavily loss-making automotive business, you had to do so. Should one expect further divestments? And have the divestments had a negative impact on your standing as a sustainable buyer in the market?
I'm going to answer the last question first. I mean, did we have no, in contrast. I mean, basically, it was highly valued by the market that we finally sold the automotive suppliers, and that we closed this chapter in this history, because it took obviously a lot of investments that haven't been producing a return for a lot of years. And it's very hard as well to to sell the assets, but at one point, if you don't have the instruments left within the company, you have to take action. And I mean, I'm just saying what management has been saying, as we've learned out of these experiences, maybe to act a bit rigorously here and there, but still sticking to our buy, hold, develop values. But if you're burning value for a long time, you shouldn't be keeping the companies. And for instance, we closed down, you might have seen in the media, but it's a bit hidden here and there. We're not talking about this that much, but we closed another portfolio company called Imeco because the business model is not further sustainable. There are other options, maybe to sell some parts of the business, but so to answer your question precisely, no, it hasn't changed our spending, not at all. And second, it might be a kind reminder to maybe act faster in the future. Yeah. Mm-hmm.
Okay, the next question is about the transaction. So how do you measure success of transaction? What financial KPIs are most important?
EBIT, because basically we wouldn't buy a company that's growing and doesn't produce any earnings. I mean, we obviously look at the profitability profile when we are acquiring the company, and if it being a success, in the end, it is how it contributes to our profitability profile, because we want to grow profitably in the long term. Nevertheless, there might be some years where you have investments, right? You want to internationalize, but nevertheless, the long-term target is profitability. Yeah.
Then there is another question about M&A. What is the key focus in regards to add-on M&A? Do you prefer cost or growth cases?
Basically, it's interesting because we acquire mature companies that sometimes are still growing. I mean, because there's such a niche. But it's very important that we don't take restructuring cases. That's very important. So they've got healthy margins, and INDUS exercise or position is to bring them to the next innovation step, to bring them to the next sustainability step, and to improve operation performance.
The next question is about geographic sales distribution. With the ongoing economic uncertainties in Germany, will INDUS become more focused on other regions?
The specialization will still stay Germany, or the German-speaking Europe, we say, which includes Switzerland and Austria. We're obviously looking more and more at companies that have an international footprint or how to internationalize into existing companies. But I think this is maybe a misconception, because more than 50% of our revenues is coming from outside Germany. But the knowledge base and the specialization of these German Mittelstand companies will stay Germany. Mm-hmm.
What is INDUS' exposure to the construction industry? Would you expect an uptick in demand once interest rates start to come down?
Exposure, sorry, I'm turning to the annual report. So a third of our revenue is coming roughly from infrastructure. So basically, this is like around 580 million. Yeah, this is exactly a third of that of our revenue. Obviously we are moving with the interest rate and with the sentiment. But I'd say because the segment as such is diversified, like 1/3 is residential and 2/3 is construction. It might not be as volatile as maybe the development is for other companies. Yeah.
And what is your long-term organic growth expectation?
Yeah, it's interesting. Like outperforming GDP basically was like this was always the target. We're talking about twice GDP was always the target. I mean, this is something now times are different, but that's maybe a good number to work with. Yeah.
Are you still confident on your 2025 targets of 2 billion in revenue and 10% EBIT margin?
Yes.
And how much for the necessary 200 million revenue increase is expected to come from M&A?
Yeah, exactly. And there's already counted in some M&A in there. So exactly, there's M&A and also organic. Usually we say 2/3 organic and 1/3 is coming from organic. 2/3 organic, 1/3 inorganic, but this time maybe 50-50 could also be.
And the next question is about seasonality. So Q1 is seasonally a weaker quarter. What is the reasoning behind this, and on what is the assumption of the recovery in the second half of the year based? Is it only based on macroeconomic forecasts?
Well, it's like basically we have a chart. I mean, like for someone who's listening now, I hope that you're still listening in, but we have a chart within the presentation. I'm going to show it to you in this NS conference. So it's on the website, and we have a segment overview for each of the quarters. And it's naturally within the Indus DNA that the first quarter is usually the weakest quarter. That's how the industry dynamics, or the dynamics at Indus works. So fourth, the strongest, third, second, then Q2, Q1. So have a look at this presentation so you can see the seasonality as well. So overall, where does the confidence come from? First of all, I mean, from the portfolio companies. That's what we're seeing in the forecast. That's what we are seeing in the order book, and obviously it is driven by the macroeconomic landscape. Yes.
Then we received another question about M&A. You have a 70 million euro budget for M&A this year, which only a small part has been used. Is there a specific industry where you further want to grow in particular?
I think it's engineering within the automation field. Materials might be within recycling and within defined mega trends. Yes, I mean, sustainability-driven infrastructure, for instance. I mean, all in these three segments: engineering, infrastructure, materials, but not in the medical segment for now. Yeah.
The next question is about order intake. How's the development of order intake? Which segments are most affected by a challenging macro in Germany regarding order intake?
So regarding order intake, the visibility is the longest for engineering. With infrastructure and materials, it's quite short. But I mean, obviously, yeah, I mean, in the end, all of the segments are quite diversified on its own. So I would say we are not trending that much with the industry trends. I'm just opening the presentation. So I'd say that let's go through it. So engineering, maybe engineering. Yeah, most probably that's maybe the most cyclical, or the ones that represents the economic situation the mostly. Yeah.
Then we received a question about personnel costs. Personnel costs increased in Q1 year-over-year, despite an overall reduction in the number of employees. Do you expect a further reduction in headcount, and how much should the average cost per employee increase in 2024?
Cost per employee, I can't say it on the top of my head, but you can write me an email. I can actually give you the number. Yeah, obviously there are group-wide cost measurement programs here and there. I mean, like if you want to get costs down, you might reduce your headcount, but this is not something we do aggressively. It's something that just comes with looking at the cost level and making operations more automated and more efficient.
Then we got a more general question. Why should I invest in the share? And where do you see the share price or the value of the company in 5 years?
Well, the share price, I'd look at I recommend looking at NuWays, so at the recommendation. So why would you invest in Indus? I mean, putting it all together, looking at the revenue growth, the around 10% EBIT margin, the around 100 million of free cash flow, the dividend we are paying, and the return on capital employed. Well, depending on how you calculating it, it's quite an attractive mix, I'd say, of the German industrial capital goods. And you have a diversified industrial landscape, which otherwise wouldn't be represented in a portfolio, as to speak, and you wouldn't have access to the companies that we have in our portfolio.
Then another question about M&A. Which aspects do you take into account in making acquisitions?
We defined megatrends. We defined some megatrends for each and every single segment that we say we stay within these megatrends. We defined hard numbers like 20 to 100 million of revenue, around a 10% EBIT margin, a good equity ratio, and no liabilities. So no restructuring cases, but niche players that have a industrial technological value chain, which you can further develop within the Indus toolbox of innovation, sustainability, or operational excellence program.
About working capital. Your seasonal increase in working capital in the first quarter was lower than usual. Well, what is the reason for this development, and how's your expectation on the usual working capital reduction in the second half of the year?
Well, working capital picks up with business dynamics, so I'd expect it to be, well, I wouldn't expect it to be decreasing that much because compared to last year, I mean, well, let's think. Are you comparing to end of last year? Or Q1? No. So obviously, I mean, like looking at, well, from Q1 to Q2, you will see an increase in business dynamics. So obviously, working capital will also go into that direction. But maybe the normal trend is that obviously working capital is going down throughout the year. I couldn't say put a number on it, but what I could say is that the effect on the free cash flow will be lower, the positive effect on the free cash flow. So therefore, we're just thinking to generate above 110, not maybe a 200 million.
If you look at buy and build companies in the Nordics, we see completely different valuations on the stock market. What would you think are the levers that could enable the gap to narrow?
Yes, that's what we're working on, and we've been working a lot on the external perception, and luckily we have a big Norwegian shareholder who is mirroring these valuations in Scandinavia. And I think what we have to present stronger is our numbers, like the EBITDA and our return on capital, and maybe our long-term targets. And we've been dragged a lot by this automotive supplier units the years before, and now it's out of everyone's head. We can start over freshly and put the attention more on the mega trends, on the companies we've recently acquired, on the profitability profile. But overall, I think we have to present our numbers. That, for instance, ROCE, free cash flow. We just introduced free cash flow actually 1 year ago as a figure to the public. So this might help also. Yeah.
So currently there are no further questions. If there are no further questions, I want to thank you, Ms. Sanac.
Thank you very much. It was a lot of fun and a pleasure to present. I like this format a lot, and I hope everyone has got their questions answered. Otherwise, please contact me or contact Konstantin.
Yeah, totally. So thank you everyone for your time, for participating in our roundtable, and have a pleasant day. Goodbye.
Thank you very much. Thank you.